Welcome, Jimmy, to 2025.
I got to be honest with you, it's still a little weird to write the number 2025 on any file that I've been saving and date stamping it. It's strange to see 2025, but here we are.
It feels a little futuristic in a way.
Yes,
My son's also graduating from high school in 2025, so it's been out there as a date, and now it's here.
it's coming.
So, well, we're happy to be with everybody, and this is our market insights for Q1. We do this every quarter, and we're looking forward to talking about some different points and really diving into some of the details in greater depth.
Let's get after it.
Our big portfolio points. We've got a new sheriff in town, a new boss in DC.
Yep.
I think we all know his name. And then we've got the economy. How is it doing? And then, of course, there's a variety of opportunities that are present there all the time. And
Correct.
here's some of the opportunities that we see in 2025.
Yep. Sounds good.
All right. So Donald J. Trump, he was the 45th president. Now he's the 47th president. He comes in, and what they're saying is that he's coming in with a much more concrete, much tighter agenda than he had the first time in 2016.
Sure.
And so, but there's still a lot of policy fog out there.
Yeah, a lot of unknown, right? A lot of uncertainty. And I think we saw a lot of the markets reacting to the uncertainty post the election. They had that big, boom the day after the election, and then, tariffs and the policy and what is immigration and a lot of these things that you see on the screen here, taxes, what is it going to look like, and how do they eventually flow through from a portfolio points? How does the new implementation of whatever the administration is going to do affect the economy, and then like what type of opportunities are presented from that? So I think we've got it set up pretty well here to walk through.
I think so too. And the policy fog, it will start to clear up. It's already starting to clear up here as Trump has just been inaugurated, and already putting in some executive orders. So we know reshoring is a big deal. We're trying to bring more manufacturing back home. There's this thing called friendshoring too, and that's maybe working with your partners out there, not necessarily your home country, but somebody who you got a partnership with,
Right.
Your friends.
Yep.
There's a lot of talk in those two things that where they're not saying the word China, but it is about China.
Definitely.
Right. So we know that we have an adversarial, but still necessarily trade relationship with China. Okay, got it. This thing, payment for protection, I saw this recently in from our friends over at Canvas at O'Shaughnessy Asset Management, and this was interesting. They highlighted something that Trump is trying to do, which is to say he wants countries to get protection for payment.
Yeah.
And so the payment really means that those countries are investing in long-term treasury bonds, like 30 plus year bonds.
Right.
And I just thought that was a super interesting business move.
Yeah.
And it entwines countries in so many different ways.
Absolutely. I mean, that's as we you see the national debt in the and that's a concern for many. But as long as people are continuing to buy long-term treasuries and are willing to buy the bonds of the United States, the debt level is not as concerning. It's when do people stop? Do they stop seeing the U.S. as a credible investment opportunity and stop buying that? Then all of a sudden the debt burden becomes a much more important factor.
That's a great point. Tariffs, I think, are just problematic if I'm giving the straight answer on this.
Yeah.
Because they drop oftentimes to the bottom line in terms of cost in the marketplace, and by extension, they're inflationary.
Yeah. My hope on this is that it's a negotiating tactic, right? Like let's start way out here, and hopefully we can work our way back to a more sensible agreement.
And then we've got this hot topic of immigration and deportations. There's the Trump administration already got itself into a little bit of a hot water, call it, with immigration and how they want to provide some immigration to certain countries. I think India was one of the ones that they're looking for a very high tech, kind of highly educated kind of visas to be given to certain populations.
Right.
And a lot of American companies are clamoring for this, right?
No doubt.
At the same time, we've got the idea that there's a lot of people here illegally, right? And we
Mm-hmm.
need to deport them. And then the question is who and how many
And how,
and how
and when,
and when,
yeah,
right? And so again, is this rhetoric around the election cycle or is it reality? I don't know.
yeah, we'll find out.
Taxes, I think, is something that's going to be more concrete.
Yeah, and this is something that I love. Any the change in the taxes is an opportunity for planning, and it always is, right? And the only thing constant with taxes is changing, right? I mean, we've seen it year over year. Different administrations, different focuses. Have different focus on different parts of the tax code, and whether we're talking about a state income tax or corporate income tax or individual income tax. The potential for change is here as the new administration has just been inaugurated. But maybe because the 2016 policies that he implemented then that were set to sunset next year, maybe we see a little bit more on the individual side of just business as it's been for the last few years. But who knows? We'll wait and see. It's going to be interesting to see how that all unfolds.
It absolutely will. We'll definitely be keeping abreast of all that and make sure that our clients and everybody is well aware. So now we're going to jump over to the economy and look at what it looks like through a couple different lenses. This is more of a world economic from the International Monetary Fund. So they're predicting in 2025 the global economy is going to grow at about 3.3%. Okay, if I take you to the far right hand side here, this is the developing and emerging markets. They typically have a higher growth rate,
Right.
right? So we're above 4%, and then you go to the advanced economies, and they're right around 1.92%.
Yeah, so you get your nice blend there,
Yeah.
right, of your advanced economies and then the developing, and you come up with this, overall number. And I would just say, my quick takeaway from this is that's a pretty healthy growth rate. If that blend truly is, if we're going to get 3.3% globally in 2025, I'd feel pretty good about that.
And there's opportunities out in the marketplace too. So, again, this is not a bias. This is an observation. The observation is that there's still opportunities in there in the international markets.
Absolutely.
All right, going back to the U.S., the GDP growth here, again, strong, right? We're predicting actually that 2024 was right around 3%, and 2025 probably right around 3% too.
Yeah, again, I think the most important thing that I focus on here is, when you're looking at the share of the nominal GDP, it's the consumer,
Yep.
right? And the consumer. It's always been somewhere in that 2/3 to almost 70% of the economy is driven by the consumer. And if the consumer still has a job, they have, cash inflows, the economy is going to tend to do pretty well. And that's kind of where we're at still, right? So it doesn't surprise me that 24 the numbers were what they were, and that we're still projecting a similar number for 2025.
Yep. And in a couple slides later, we'll look at the consumer and their psychological and their emotional buildup. Like, what are they feeling?
Right.
So in advance of doing that, we take a look at inflation.
Mm-hmm.
And of course, this has been the topic for many years. The good news is it continues to kind of fall steadily.
Right.
There's concerns about tariffs and inflation, as we mentioned before. But listen, we're sub 3. We're right in the 2.7-ish range. And we know it's going to be sticky to get down to the Fed's target of 2.0.
And listen, we are certainly not economists. We're not experts in this. But you hear a lot of folks that comment on this and think it's going to be impossible to get to the Fed's 2% target, and that the Fed might just need to be willing to accept slightly higher than the 2. Maybe it's 2.5%. And how much of a difference that? Well, it does have a big impact over long periods of time. The difference between 2 to 2.5 or 2 to 3. But nonetheless, I would say this is still a promising trend here. Falling from the June 22 highs of 9%, over 9% to where we're at now, sub 3. We're trending in the right direction. And we were talking about this. I remember, last year and probably even in 23 as well. We were talking. This stuff is going to be sticky at the end. It's kind of easy to trim off the start. It's the stuff at the end to get to your long-term target is going to be a little more challenging.
Agreed, 100%. All right, we were both talking about this slide. It's kind of fun. It's kind of interesting. Benjamin Button, your golf. Remember the movie
Right.
from years ago with Brad Pitt in it, where uh, basically he ages in reverse.
Yeah.
He's an old man going back to being a baby.
Yeah.
And so the reason why this is apropos here is that you've got this weird cycle change in the U.S. economy where we were in the late cycle typically trending towards recessionary environment, and we seem to have pushed ourselves back to a mid-cycle place in the roller coaster.
Which a lot of that has to do with the whole like soft landing thing that was a big topic of debate. And is it reality that you could land this thing without triggering a recession? So if you think about June 22, we had over 9% inflation. So what did the Federal Reserve do? They raised interest rates at a level and at a rate, a velocity that we've never seen before historically. And the fear of that is you keep raising rates, it's gonna, you might break something in the economy.
Yes.
It's not a surgical tool. That's like a blunt force object to start curbing inflation, which was obviously necessary, but you just don't know for sure what the actual impact is going to be. So I think what you take away from this is that the Federal Reserve has done an admirable job of not crashing and crushing the economy with the rate hikes that they implemented. You could certainly argue that they waited too long to do so, but nonetheless, where we're at today in this Benjamin Button scenario here is better than having continued down to the recession part of this graph here. So funny to see. But then you start to look at, so what are the elements of a mid-cycle, which is kind of where we're at now. Profit margins peaking, employment improves, and we've seen steady employment. I mentioned that earlier, and the demand for credit picks up. And so I think those are all
it's accurate.
Yeah, they're elements that we're seeing in today.
And it might not again be where people are, how they feel.
Right.
How you feel and the numbers can be very distinctively different. But this is where economists are seeing the economy in terms of its cycle. So again, going at that mid-cycle look, what does that mean for U.S. equity returns? Well, pretty good.
Yeah.
Pretty darn good, in fact. And so could you say an average here is 14%? Is that the call out for the year, 14%? Well,
right.
I mean, gosh, I don't know. I mean, people,
I wish I knew.
People predict this every single year, and they're usually wrong. And
Yes.
but, nevertheless, from a historical perspective, mid-cycle, you're really looking at about 14%. And it's pretty good across the board.
Right. Yeah, I think what I take away from this is looking at the different sectors and the different stages of the economic cycle. And what you start to see, or the term you'll hear oftentimes is a sector rotation. So in certain economic environments, different sectors are going to have more opportunity for growth, and then when you get later into that, you see these numbers sort of start to flip, where they were strong early, maybe they're weak later, right? And that's what you see in the graph here.
All right, we've been alluding to this a little bit. This is the consumer confidence. We've had this slide in there before, just to point out the dotted blue line is the average consumer confidence. This is a long-lasting survey done by the University of Michigan. And, then you can see where we are at any given point in time with the plots there in black. And I guess the interesting thing here is a couple of different things. Is that number one, forget about how you feel, because it doesn't portend to predict anything about how the markets are going to behave.
I had a wonderful golf coach in my younger years who explained to me that feel and real are not the same. And I think that's what I see here is when particularly when you look at the points of the peaks and the troughs, you see really good investment returns moving forward when you're at the bottom and you're below the average, and then you see the markets tend to not do very well when the consumer sentiment is overly bullish. So feel and real are not the same.
They are not, and so we want people to try to, as much as you can, divorce those feelings,
right?
And just look at it from what it is, and that's not to say that everything is going to be great because we are where we are in the confidence cycle.
Correct.
It does not mean that. But it could mean that.
Yeah, it's another important data point to take into consideration when you're thinking about how you want to allocate your resources.
Yeah. All right. So then again, looking backward, short term backward, 2024. This is an asset allocation examination of how the market's performed. So on the top in the purple, that's all equities, returned about 25%.
Really good year.
Really great year. On the bottom with all fixed income, not really that great, 1.25%. And with the yields being like they are, that's a little surprising to people. But the fixed income market went through a lot of gyrations,
Yeah.
and it was a little tough. But this is why most people aren't at either end of the spectrum; they're somewhere in between.
Correct. Yeah, that's the importance of diversification. Again, I think to your point here, the fixed income market has saw a very interesting year in the sense that starting the year out from where we're at from a yield perspective, and knowing that we were in a rate cutting cycle, you would have expected better price returns for the bonds, and that's just not what we saw.
That's right.
So there's a number of potential explanations for why that is. Nobody can tell you exactly why, but there's a number of theories out there as to why. But yeah, we saw rates, and we saw that looking at the yield curve, the rates didn't go the way that we thought they would have in a rate cutting cycle.
Mm-hmm.
So you didn't get as much return in the fixed income, but maybe you got more return in the equity markets than what you thought you were likely to receive in 2024.
Perhaps. Like the 60/40 did very well. It's roughly a 15% return. And this is pretty consistent with most of the client portfolios that we see.
Correct.
A couple things that we just want to point out here, that the year was dramatically undramatic.
Yes, yeah, especially for an election year.
Mm-hmm.
Yeah,
So,
not a whole lot of volatility.
No, it had your kind of typical dip in the summertime where the markets went down a decent amount for sure. But that's a seasonal cycle typically.
Right.
And then Trump was elected. You had this kind of very quick-lived Trump trade where the markets went up in an instant of euphoria or maybe relief.
Right.
Might have been another way to put it.
Sure.
And then then December usually has a Santa Claus rally, and it did not deliver.
I mean, Santa might have delivered a lot of presents to kids out there, but he did not deliver to the stock market in December.
No. So it was a poor ending to the year, but because we had such a good year overall, we sustained good returns.
Yeah, absolutely.
So this is how the periodic table of returns looks. This goes back, 14, 15 years here. But let's take a look at what we've got highlighted in yellow. This is 2024. Large cap did really well. That's not a surprise. I mean, it was a dominant player.
Yep.
We're going to get into some of the individual reasons why that was. It's a couple of different stocks.
You're right.
Called the Mag 7. Small cap did really well.
Yeah. I mean, it's small cap tends to have a good bit of volatility, as you can see in the chart here. If we're looking near the top left, that the volatility, small cap is the most volatile asset class on this periodic table of returns. But you were rewarded for owning small cap stocks in 2024, being the second best return. What I love about this one, though, is seeing that the asset allocation, the 60/40 portfolio, is the third best returning asset class. The blended asset classes here in an asset allocation strategy was the third best return.
Yeah, this is our belief that being diversified through asset allocation is the best way to play it. So it is nice to see a year in which you're really flexing the muscles associated with that, right?
Right.
So, yeah. So I don't really have anything more to say. Do you?
No, I mean, again, the fixed income at the bottom there is still interesting in that cash outperformed fixed income. And last year, everybody was telling you get out of cash, start getting more duration extended in your fixed income side of the portfolio, and that just didn't play out in 2024.
And that does not mean that they won't in 2025.
Correct, exactly.
But geez, that was a bit of a head scratcher for sure. All right, let's take a deeper dive on equities.
Yep.
Here's some inflection points on the S&P 500. We really just love taking the long look on the market. We're long-term investors at heart, so you can kind of see how this market has played out over the years. The one thing that I wanted to point out was that we are getting a little frothy in terms of the forward PE ratios.
Right.
Speaks to valuation, and Right now, the averages are right around 22 times.
Right.
And what does that mean, Jimmy? That means that the probability of good returns is really, it shrinks a little bit. It shrinks the window a little bit for
Correct.
that. And the possibility of lower returns in the future is a little bit more likely,
Right.
potentially.
Yeah.
That's if you look at things through a historical lens, but you don't always have that capacity to do so. You sometimes have to look through it through a different lens and say, okay, what's different here now?
Right.
AI is
Right.
different,
Sure.
perhaps. different things,
Yeah.
different aspects and motivations for the markets.
Yeah, no, absolutely. And I think one of the numbers that I find really interesting looking at this is looking at the forward PE for sure, but then also looking at the 10-year treasury yield at that time.
Yeah.
And that's kind of been like something that we've noticed in the market, that when the 10-year treasury has risen over 4.5%, stocks have struggled. There's been more volatility because your people, longer term investors are starting to say, wait a minute, I could get above 4.5% guaranteed, locked in for 10 years.
Risk-free rate.
A risk-free 10-year locked-in return. That seems more appealing to me now because I'm, that or buying stocks at 21 and a half times future earnings. My trade-off might be a little bit better, and from a risk-return perspective, you might be not getting enough return for the risk you're taking buying stocks at 21 and a half times. But again, that's not to say that this is something that's going to come crashing down immediately.
Correct.
It's just an observation at a moment in time that we're getting a little bit on the frothy side.
We are. And so, we didn't really have any big pullbacks in 2024. I would just say my expectation is that we will have some sort of a decent bear market in 2025. That's no reason to run for the exits.
Not at all.
But it's a natural course of doing business, and it happens very consistently throughout time. I would just expect it.
Yeah, I mean, you're coming off 2 years of over 20% returns in the U.S. stock market. I think it's reasonable to expect some sort of breather in the stock market.
All right, the Mag 7 or the Magnificent 7 are these 7 large cap domestic stocks that are driving a lot of the returns inside of the S&P 500. And so NVIDIA was the all-star
Right.
in 2024. And one of the interesting things that we heard was that if the S&P 500 didn't have NVIDIA, that the European stock market would have outperformed the S&P 500.
That's a crazy stat.
That is a crazy stat.
Yeah, I mean, look, it obviously had a huge impact. I think so. When we're talking about the S&P 500 again, for a reminder, we're talking about like the 500 largest U.S. companies. I tend to view the S&P 500 is a market cap weighted index, meaning the stocks that are held within the index, they can increase their overall share by outperforming the rest of the constituents, right? And so NVIDIA did just that, right? They outperformed everybody else, so their weighting in the S&P 500 had increased throughout the course of 2024.
Exactly.
I view that more as a feature than a bug, quite honestly, because you're able to then, by having your money invested in a strategy that tracks the S&P 500, you're getting more of the company that's winning the most.
Yep.
And now at some point it might be a bit of a bug, but I think over long periods of time it's more of a feature to the an index strategy than a bug. But you do start to get concerned when the weighting of such a small number of the stocks in the S&P 500 make up such a large share of it.
Roughly 40% of the S&P 500 did not have a positive return in 2024.
Right.
That might be shocking to people, but again, as a function, 60% did.
Right.
Okay, so number one, it's a majority.
Yep.
Number two, your weighting piece is really important to understand how some of the bigger guys outsize their returns.
Yes.
And here's the deal. We've seen the Mag 7 and the S&P 500 minus the Mag 7 kind of fluctuate over the years. What I'm referring to is the earnings growth in particular. In the upper right-hand corner, this gives a little bit of a forecast. And what the JP Morgan team here is forecasting is that you're going to see the rest of the 500 catch up. The
Right.
493 stocks, call it, catch
Right.
up a little bit more to the Mag 7. Or
Right.
maybe another way of putting that is the Mag 7 is going to take a little bit of a back seat,
Right.
and the others are going to step up.
Correct. Yeah, that comes back to that whole sector rotation thing we were talking about before, right?
Yep.
If you got these seven have been driving the bulk of the return for such a long period of time, you need the market to take a bit of a breather, and part of that might be through sector rotation, and those that weren't the big winners previously maybe are the better positions to be invested in 2025.
So drilling into a little bit of an opportunity area, we've heard some really smart portfolio managers diving into the research inside of the markets and looking at the healthcare
Yeah.
industry and saying, boy, what a great opportunity to buy something at a relative discount, and the prospects of the health industry doing well over the near and long term are strong.
Right.
Right.
Yeah. So again, when we're talking about PE here, this is the price relative to the earnings per share of the companies that we're looking at. And so, at some point in time, price does matter. And if you're able to, one of the things that we want to do with stocks is buy them when they're on sale, right? And this is sort of what we're talking about there. This might be an opportunity to identify certain stocks or a sector that is maybe on sale and has good prospects for growth into the future.
Agreed. So what are we saying here? Really, you look at it and exactly what you were just saying. There's some opportunities where these indexes or subsectors of, say, the S&P 500 can be on sale.
Right.
Good opportunities to look at. Fixed income. Did I dive into this just a little bit here? We're not going to spend a ton of time. So is it golden age for yield, or is that just an overstatement in our title there? I don't know.
I mean, I certainly think just at a quick glance, you look at the blue diamonds, which is the current level of yields, and you look at the purple bars in each of the different types of fixed income that we're looking at here. Is that the purple is a 10-year median, and really across the board, with the exception of emerging market debt, the current yield is well beyond its 10-year median. So golden age, I don't know. I guess time will tell if whether that is an overstatement, but from a quick, from a moment in time and looking at it right now, as from a snapshot, I don't think it's overstated. Certainly an interesting dynamic from the fixed income market last year with the yields where they were, and then the price pressure that we saw on the bonds through rising yields. And so maybe 2025 is the year that you get paid off for having taken money out of cash in 2024 and extending the duration of your portfolio. But again, time will tell.
The case for yields could be made on two different levels. Firstly, if there's price stability within the market, you can stop some of that downward pressure that took place in 2024.
Right.
If the Fed does happen to cut, which there's not a lot of prognosticators saying that they're going to be super aggressive in their cutting cycles.
Right.
But if they just stay pat, if they pause, it's probably gives that yield stability that maybe we're looking for a little bit here.
Yeah, I think that's well said.
So there's that, and the fact of the matter is, if you go back to the fact that we're really in a mid-cycle for the economy, credit defaults should be low,
Right.
and your risk associated with getting into the bond market are much lower. It's a pretty sound and sturdy place to go, I think, in 2025.
Absolutely agreed.
We're going to talk about some new and some old themes here, some opportunity areas too. So ETFs are exchange traded funds. They've been around for about 25 years now. I think that's correct in saying that. The first ones came out in the late 90s. They've mostly been in the form of passive ETFs, meaning you're tracking a benchmark like the S&P 500, the Russell 2000 for small cap, you name it.
Yep.
In recent years, the trend has been going towards active ETFs. Explain to us what that means.
Yeah, so again, I'd say so ETFs are most commonly compared to mutual funds. And ETFs, I think, on the whole, are a great tool and a great investment vehicle for investors to utilize for investing their money. lower cost. There's but the change that we've seen here is active investment management, which is having a portfolio manager actually picking and choosing what stocks to buy and to sell within the fund. Hasn't really been done much in the ETFs. It's been very common, and going back for mutual funds,
Yes.
for I don't know,
Decades.
50 decades.
Yeah.
That type of management's been done in a mutual fund, but the ETFs are a much more tax efficient investment vehicle relative to the mutual fund. So now being able to get active investment management at a lower cost with increased tax efficiency, I think on the whole is a wonderful thing for the investor.
Agreed. It's really exciting. This is an exciting space, and most of the new ETFs out there are in the equity side, as you can see from the bar graph here. There's a sliver too in that red space that we believe is where they're putting some of these unique different ETFs that are sort of an alternative style, and they
Right.
have maybe some options trading on them.
Right.
These are interesting. We're going to talk a little bit about that. So within that space, there's this thing called buffered ETFs. And so they are using options strategies overlaid on top of usually some sort of a benchmark, like the S&P 500, but not exclusively.
Right.
And it allows you to kind of maintain a certain level of predictability around the outcomes.
Right. This is sort of like the potential to have your cake and eat it too,
Mm-hmm.
right? Where you can limit your downside risk exposure if you believe that the market is frothy and you're not very comfortable being fully invested in the S&P 500. Well, you got a way that you could still participate in some of the upside, but really limit your downside. And I think these typically you've seen in investment strategies like this only available to investors in the form of some type of annuity,
Mm-hmm.
right? Whether that's like a fixed index annuity or it's a variable annuity of some sort. And those products have come historically with, I think, a lack of transparency for investors. I think they come with a high level of cost associated with the investment product, and maybe not the most tax efficient.
Right.
So I really think that this is a wonderful sign for the industry as a whole that you're now able to get access to a product that has features like an annuity that, but also offers daily liquidity and much lower cost to get into. So again, I view this as like a really cool development for investors to be able to gain access to a product like this, but again with daily liquidity, with a better cost structure and more transparency within what do I actually own.
Me as well. And just to talk about the cost piece for a moment, so cost on something like this would typically cost, over 1%, sometimes a couple of percent in the annuity space.
Right.
And a lot of that's hidden. A lot of people don't understand that. It's really, really kind of an under the radar type of thing. These ETFs, the going rate seems to be about 50 basis points.
Right.
So a little bit higher certainly than a passive fund would be,
Sure.
no doubt, right?
Right.
But what you're getting is pretty extraordinary for the value.
Correct.
So talk to us a little bit about these buffered ETFs. We're using the example from iShares, BlackRock iShares. They've come out with ones like DMAX and SMAX.
Right.
Talk to us a little bit about these.
Yeah, so essentially what you're seeing here, if you look at the first column in the chart on the left there, the starting and then the remaining, the starting cap. So what that's telling you is this investment, if I own it starting on December 31st or by January 1st, and I own it for all 365 days of 2025, the cap or the maximum return I could get from this investment would have been 7.9%.
Mm-hmm.
And then the downside before the buffer is 0.5%. That's the fee to it. So essentially, the maximum amount of money you could lose is just the fee that you paid to BlackRock over the course of the year, which is 0.5%. So your return is going to be somewhere between minus 0.5% and positive 7.9% if you owned it on the first day of the trading year.
Yep.
Now, if you were to buy that ETF ticker at any other point in time during the year, the potential investment return will be different. If you're buying when the S&P 500 is already down for the year, then you now have more upside.
Yep.
But if you bought it when, let's say, the S&P 500 was up 5%, well, now your downside protection is still down to negative 5%. But if you buy it up, or negative 0.5%, if you buy it when you're up 5%, now you've got about 5.5% potential loss on that investment.
Right.
So the timing of when you buy these things, I think, is really important. Again, right now they're only released quarterly. I think there is going to be more of a move to continue to issue similar investment products on a more regular basis. Maybe it's monthly, but for the time being, right now it's only quarterly. But there's been quite a bit of demand for products like this, given the features we were talking about with daily liquidity, more cost efficiency, and a little more transparency in the investment. So
Well said. I love how you explained that. There are versions of this. This is a fully buffered ETF,
Right.
meaning it's going to give you sort of that near 0% downside.
Right.
There are others that give you downside protection, but not full downside protection.
Correct.
JP Morgan has some really good ones too. But the point is, it kind of depends on what you're looking for.
Absolutely.
So here's, again, an example of how that works. I think you're showing exactly what you talked about here. On the left-hand side of the screen, you've got the IVV. Let's say it's down 15%. Well, you're not going to be down 15%. You're going to be
flat.
You're going to flat.
Yeah.
If it's down 5%, you're going to be flat.
Right.
Right? If the market goes up 5%, you're going to be at 5%.
Right.
If the market goes up 15%, well, the S-Max was issued in June. Okay, and it had a cap rate of 10.64%. That means you're going to get 10.64%.
Right.
The S-Max was issued in September. Thank you. A different time. Every different time that they release this, it's going to be a different cap rate,
right?
Depending on the dynamics of the forward looking I think it's a forward look through the options market.
Correct.
Right?
Whatever those options cost, that's going to determine what your cap rate is. So
exactly.
You won't know what the cap rate's going to be for the next ETF that they're going to issue until we get basically like a couple days before the
little prospectus that they'll put out about it, and here we are. Right. But again, very interesting things for people to consider. You could see this as an alternative to fixed income, potentially.
Right.
You don't have to look at it through that lens. You could also see it as just a way to invest. But again, know that you're going to take a haircut on some of the upside in order to get that downside.
Correct. Yep.
All right. Now we're switching gears. Tax loss harvesting. We talk a lot about tax loss harvesting because we believe that taxes are one of the fundamental ways that you can outpace and outperform the market on a net of tax basis.
Right.
So doing in an after-tax account, performing tax loss harvesting has been around for a long time, typically done at the end of the year.
Right, exactly.
Because it's typically been a manual process.
Right.
Go in and intervene at the end of the year. Do I have any losses in any of these holdings? If I do, go ahead and sell them.
Right.
That's kind of a concept, right? It's really old school and it's not enough, right?
We agree.
Yeah. So this is looking at 2024 and it's looking at a couple different things. SPY or SPY is the S&P 500 ETF. AGG is the that's the Bloomberg Ag.
Yep.
For the bond market. Tell us what you're seeing here, Jim.
Yeah. Again, if you waited till the end of the year to try to harvest losses in your S&P 500 holding, you were gonna get to December and realize I don't have any opportunity for loss harvesting. However, if you had been looking at this on a daily basis, there were opportunities earlier in the year to harvest some potential losses, and we were able to do so for our clients. We obviously see a lot less of the loss harvesting in the fixed income markets, given the different levels of volatility that surround stocks compared to bonds. But nonetheless, there was an opportunity, well through the midpoint of the year that you could have sold some of the bonds that you had that had been under pricing pressure in the first half of the year. You could have sold them and bought another bond investment and had a positive rate of return for the year, but had booked a capital loss. So again, to your point, we're not, we're trying to help our clients and investors outperform the benchmark net of taxes. And if you're waiting until the end of the year to do this type of work, or if your advisor waits till the end of the year to do this work, it's too late.
It is.
The loss harvesting is available throughout the year. So don't just it's not a fourth quarter or 12th month of the year task. This is something that needs to be looked at on an ongoing basis.
A couple of the ways that people can look at this is through selection of really, really strong portfolio managers, money managers who have strong algorithms to kind of take into effect the ability to examine and pull the trigger on losses at the right times.
Correct.
And we use Canvas and we use Parametric for that. Both do a fantastic job of that. If that's something that people are more interested in learning more about, we're happy to have that conversation with you. Switching gears, investor temperance. I heard Josh Brown say this on one of his recent podcasts, and I just thought it was really an important term. We have to be aware of these things called unconscious biases that we all hold.
Yeah.
They are a part of our emotional and cognitive makeup, and there's a bunch of them.
Right.
And you can learn more about them by just Googling them, quite honestly. It's pretty interesting.
Yeah.
There's great books out there as well on this subject. If anybody wants to know a little bit more about it, we're happy to help point you in the right direction. But one of the things we want you to know is that, look, there's going to be times in this upcoming year, we think, where you're going to be struck with the notion of, loss aversion or
Right.
A negativity bias anchored into a particular price point
Right.
that's going to really make you want to do things that maybe you shouldn't do.
Right, exactly. I mean, look, behavioral finance, behavioral economics have grown in popularity massively in the last couple decades here. To your point, a lot of really good books. You've had a bunch of Nobel Prize winners win the prize for their work in this subject area. It is incredibly, I find it incredibly interesting to read and to learn more about, and then start to sort of take them from an unconscious bias to becoming more consciously aware of the biases that you might fall victim to, or that you're more likely to fall victim to. And it's nothing bad, right? It's how we're all wired differently, and these biases affect us in different levels. But certainly interesting to be able to go from it being unconsciously unaware to consciously aware of potential weaknesses in your ability to discern information and make proper and objective decisions for yourself. The whole progression of that is really an opportunity for us to learn more about ourselves, be better aware of who we are, what are our downfalls, and allow us to make better objective financial decisions.
Good financial advisors are going to be your coach. They're going to be your companion along that journey to help you through not just the good times, but also the bad times, in order to make sure that you're not doing things that are going to ultimately be harmful to your bottom line and your long-term success, to your goals that are individual to you.
Right.
Which is to say, we are both certified financial planners. We believe in making a financial plan and making that the hallmark and the core, the heartbeat of how you operate as an investor.
Absolutely. I think we finish this segment every time with the same chart here, as we showed, the same graph. Look, you need to have a financial plan so you understand all the various impacts of the cash flows and the assets and the liabilities that you might have, and how's the interplay of them all work out for you, and how do we allow you to help make better financial decisions.
As always, well said, my friend. That's going to do it. If there's anybody who wants to get in touch with us, we can be reached here at hello@OnTrackPlans, or the phone number's up there. We're available and ready to give some good advice. So look forward to talking.
Awesome.